The decision to impose a tariff on gold marks a significant departure from traditional trade policy because gold is not just another traded good like steel, oil, or wheat. It holds a unique position in the global economic system as both a commodity and a financial asset, serving as a store of value, a hedge against inflation, and a safe haven in times of economic uncertainty. For centuries, gold has been viewed as a universal currency, trusted across borders and political divides. Even in our modern, digitized financial world, it retains a symbolic and practical role in underpinning national reserves and investor confidence. The United States' choice to target gold with a tariff signals not just a shift in economic tactics, but also a willingness to disrupt one of the oldest and most stable pillars of global trade. By making imported gold more expensive, the U.S. is attempting to alter the incentives for importers, refineries, and investors. On the surface, this may seem like an effort to protect domestic industries, such as mining and refining, but the deeper implication is about reshaping the flow of capital and asserting control over a market that most nations treat with extreme caution. Gold's price is determined globally, influenced by central bank policies, currency exchange rates, and macroeconomic sentiment. By inserting a new cost layer into this system, the U.S. risks distorting those delicate balances. Investors, aware of gold's role as a psychological anchor in times of instability, often respond to even small disruptions with significant shifts in buying and selling patterns. A tariff forces them to recalculate risk and reevaluate where they source and store their gold. Furthermore, gold is not typically consumed like other commodities. It is hoarded, recycled, and held for long periods. This means the tariff's effects will not just be immediate, but will also echo through long-term contracts, reserve strategies, and even jewelry and technology industries that depend on gold as a material. Many countries, particularly emerging economies, rely on gold exports for foreign exchange earnings. A U.S. tariff could redirect their trade flows toward more favorable markets, potentially creating new alliances and bypassing traditional routes through American financial systems. This would weaken U.S. leverage in certain negotiations and could encourage the creation of alternative gold pricing and settlement systems outside of U.S. influence. The political dimension is equally critical. Imposing tariffs on a strategic financial asset like gold sends a message to allies and rivals alike that no commodity is beyond the reach of geopolitical maneuvering. It signals that economic tools can be repurposed for broader strategic aims, whether to pressure adversaries, reward partners, or set the stage for new trade agreements. This level of intervention could trigger reciprocal measures from other major economies, especially those with large gold reserves or significant positions in global gold mining and refining. Such retaliation could come in the form of their own tariffs, currency interventions, or shifts in reserve composition away from the U.S. dollar and toward gold or other assets. The very stability that gold has historically provided to the financial system becomes vulnerable when its trade is politicized in this way, and markets respond not just to the numbers on a tariff schedule, but to the underlying signal of unpredictability it sends to the world's wealth holders and policymakers alike. When the tariff announcement hit the news wires, the reaction in the markets was instantaneous and visceral because gold is one of the few assets that carries both symbolic and practical weight in every corner of the financial world. Within hours, traders who deal in physical bullion, futures contracts, and gold-backed securities scrambled to adjust positions, anticipating that the cost of gold entering the U.S. would rise sharply once the policy took effect. Prices on international exchanges spiked almost immediately as demand surged from buyers eager to secure supplies before the additional costs were baked into the market. This initial spike reflected a classic pre-tariff buying rush, but it also exposed just how sensitive the gold market is to even small shifts in trade policy. Once the first wave of activity passed, prices began to wobble, caught between competing forces. On one hand, the tariff made gold in the U.S. market more expensive, encouraging some buyers to pause. On the other, it fueled speculation that global gold prices might settle at a permanently higher baseline if the policy remained in place for an extended period. The ripple effects didn't stop at gold itself. Currencies linked closely to gold exports, such as those of South Africa, Australia, and certain Latin American nations, experienced sudden fluctuations. These movements reflected a mix of optimism and anxiety. Optimism from the possibility of capturing greater market share in regions unaffected by the tariff, and anxiety over the uncertainty of how global demand patterns might shift. Currency traders, sensitive to any sign of volatility, adjusted their strategies accordingly, adding to the short-term turbulence in foreign exchange markets. Meanwhile, in the U.S. bond market, the impact was less direct but no less important. Investors view gold as a hedge against economic instability, and any disruption to its market can alter perceptions of risk in other asset classes. The uncertainty created by the tariff led some to move capital out of bonds and into alternative safe havens, including gold purchased outside the U.S. foreign currencies and even cryptocurrencies. This, in turn, put subtle but noticeable pressure on U.S. Treasury yields, not because of concerns about government solvency, but due to shifting investor preferences under the shadow of policy unpredictability. In the commodities sector more broadly, the gold tariff sent a message that no market, however stable or symbolic, is immune to sudden intervention. Traders in oil, copper, and agricultural goods paid close attention to the developments, not because these sectors were directly impacted, but because they understood that similar tactics could be deployed in their own markets without warning. This kind of uncertainty increases the cost of doing business as companies build in extra safeguards and price cushions to protect themselves from sudden shifts in policy. Central banks, too, had to take notice. Many hold significant gold reserves, and a tariff affecting one of the largest economies in the world inevitably forces them to reassess the liquidity and valuation of their holdings. The psychological impact here is critical. Once a perception of instability takes root, it can influence decisions on reserve diversification, currency policy, and even interest rate strategy. The reaction from the European Union revealed more than just surprise. It exposed how deeply gold remains woven into the continent's financial stability and political considerations. In Brussels, policymakers are accustomed to reacting to tariffs on industrial goods, agricultural products, or high-tech components, sectors where disputes with Washington have played out before. But gold occupies a different category altogether, one that touches not only the trade balance, but also the credibility of the euro, the stability of central bank reserves, and the psychological foundation of investor trust. Many European nations, from Germany to Italy to France, maintain significant gold holdings as part of their national reserves. These reserves serve as a buffer against currency volatility and as a safeguard in times of crisis, ensuring that even if paper assets lose value, the nation still holds tangible wealth recognized worldwide. A U.S. tariff on gold disrupts the predictable pricing mechanisms on which these reserves valuations are based, introducing uncertainty into balance sheets that underpin European financial planning. Beyond reserves, the EU also plays a significant role in gold refining and trade facilitation. Switzerland, while not an EU member, is a major refining hub closely tied to European markets, and any shift in global gold flows caused by U.S. policy inevitably spills over into these networks. If the U.S. tariff redirects gold away from American buyers and toward other markets, European refiners might see new opportunities, but they could also face challenges if price volatility makes long-term contracts riskier. For the European Central Bank, the move raises strategic questions about whether to adjust its gold holdings or its policy mix in response to shifting market conditions. The investor side is equally important. European pension funds, wealth managers, and institutional investors often hold gold or gold-linked assets as part of their diversification strategy. They rely on stable international markets to ensure that these holdings act as a reliable hedge against economic shocks. A politically driven disruption, such as the U.S. tariff, undermines that stability and forces portfolio managers to consider whether gold's role as a safe haven might be compromised, at least in the short term. This could prompt reallocations toward other assets like government bonds, commodities, or even alternative currencies, each carrying its own risks and rewards. Politically, the move puts the EU in a delicate position. On one hand, European leaders may want to criticize Washington for introducing unnecessary volatility into a critical market. On the other hand, they must weigh the costs of openly challenging a major ally, especially at a time when transatlantic relations are already strained over technology, energy policy, and security commitments. The EU's hesitation in issuing an immediate, forceful response speaks to the complexity of balancing political diplomacy with economic self-interest. The initial reaction, characterized by surprise and quiet concern, suggests that European policymakers recognize the potential for this tariff to set precedents. If gold can be targeted in this way, so can other strategic assets, leaving no sector completely insulated from sudden geopolitical maneuvering. Canada's response to the gold tariff was notable not just for its speed, but for the clarity of its strategic intent. Within days of the U.S. announcement, Ottawa moved to position itself as a stabilizing force in global gold markets, signaling to both allies and trade partners that Canada could be a dependable alternative for transactions disrupted by the American policy shift. Officials emphasized their commitment to maintaining an open and predictable gold trading environment, reassuring investors, miners, and refiners that Canadian policy would remain insulated from sudden, politically motivated tariffs. This message resonated strongly in a moment of market uncertainty, drawing interest from nations and corporations eager to avoid the volatility now associated with U.S. bound gold shipments. Canada's leverage in this situation stems from its significant role in global gold mining and refining. The country is among the world's top producers, with mining operations in provinces such as Ontario, Quebec, and British Columbia contributing substantial volumes to the global supply. By emphasizing its mining sector's stability, Canada effectively positioned itself as a secure source of physical gold, especially for buyers who were reconsidering supply chains in light of the new U.S. tariff. At the same time, the country began exploring expansions in refining capacity, aiming to process more gold domestically so that it could serve as both a producer and a critical processing hub for international markets. Beyond production, Canada signaled an openness to adjusting its own gold reserves policy in ways that could attract foreign investment and build confidence in its role as a market anchor. This included discussions about increasing transparency in reserve management, facilitating gold-backed financial instruments, and encouraging partnerships between Canadian financial institutions and international trading houses. Such measures not only strengthen Canada's domestic financial ecosystem, but also create deeper links with global capital flows, enhancing the country's long-term influence over a market traditionally dominated by larger economies. The political implications of these moves are equally important. By stepping into a role that the U.S. had partially vacated through its tariff policy, Canada demonstrated that smaller but resource-rich economies can capitalize on moments of geopolitical disruption to expand their influence. Ottawa's stance was not confrontational toward Washington, but it was unmistakably opportunistic, leveraging the tariff fallout to increase Canada's importance to partners in Europe, Asia, and emerging markets. The promise of stable trading conditions, combined with the appeal of a reliable legal and regulatory environment, made Canada an attractive counterbalance in the eyes of traders and policymakers seeking alternatives to U.S. linked uncertainty. This approach also allowed Canada to deepen its relationships with nations wary of being caught between American economic policies and their own need for secure access to strategic commodities. By presenting itself as a neutral, dependable facilitator of gold trade, Canada tapped into a demand for stability that extends well beyond the precious metals sector, positioning itself as a trusted player in broader resource and financial markets. The imposition of a tariff on gold marks a clear example of how commodities are increasingly being weaponized in the arena of global politics and economic competition. Traditionally, gold has been treated as a relatively neutral asset, shielded from the more over geopolitical maneuvering that affects other resources such as oil or rare earth minerals. This neutrality stems from gold's unique role as both a store of value and a stabilizing force in financial systems, where its appeal lies in its ability to transcend borders and political disputes. By targeting gold, the U.S. has broken with that convention, signaling that even the most symbolically important commodities can be drawn into the realm of strategic leverage. This move sends a powerful message to other nations. Economic tools once reserved for goods tied to industrial or defense needs can now be applied to the bedrock assets of the global financial system. Such a step reshapes the way countries think about their commodity relationships. Tariffs on industrial goods often prompt shifts in manufacturing locations or the redirection of supply chains But tariffs on strategic commodities can trigger more profound changes. Nations that rely heavily on gold for reserve holdings, export revenue, or investment security may respond by altering their trade alignments or forming new cooperative blocs to reduce exposure to U.S. economic pressure. Already discussions among gold exporting countries about bypassing the U.S. financial system entirely are gaining traction, with potential moves toward bilateral agreements, alternative settlement currencies, or even blockchain-based trading platforms to avoid tariff-related disruptions. The implications also extend to how nations might use their own commodities for political purposes. If gold can be politicized in this way, other strategic resources, such as energy, agricultural staples, or critical minerals, become more likely candidates for similar treatment. Countries with strong positions in these markets may view the gold tariff as a precedent that justifies more aggressive use of their own export power. This creates a feedback loop in which commodity markets become less about supply and demand fundamentals and more about the shifting alliances and rivalries of international politics. For investors, the weaponization of commodities like gold undermines the assumption that certain markets will remain above the fray of political intervention. Institutional portfolios, central banks, and even individual savers have long counted on gold as a neutral refuge, but the introduction of trade barriers changes that calculus. Market participants must now factor in not only price volatility, but also the risk of access restrictions, retaliatory tariffs, and sudden policy reversals. This makes the cost of risk management higher and increases the appeal of diversifying into other tangible assets or currencies. On a broader level, this approach deepens the perception that economic interdependence is no longer a guarantee of stability. Instead, it can be exploited as a point of pressure where countries use their role in critical supply chains as leverage in unrelated political disputes. In such an environment, trust in long-standing economic norms erodes, and every major commodity, no matter how historically neutral, becomes a potential bargaining chip. The globalized economy has often been portrayed as an intricate web where nations are bound together by trade, investment, and mutual dependency, creating a system in which large-scale conflict is discouraged because the costs would be too high for all participants. Yet the imposition of a tariff on gold and the subsequent reactions it triggered illustrate how that same interconnectedness can magnify the effects of unilateral policy decisions, producing outcomes far beyond what the initiating country might anticipate. When a commodity as universally recognized and valued as gold becomes subject to targeted economic measures, the repercussions spread quickly across continents, cutting through industries and financial systems in ways that defy neat containment. A tariff on gold not only alters the price and availability of the metal, but also forces a realignment in supply chains, trading relationships, and even central bank strategies. The very nature of globalization means that no single nation controls the entirety of a commodity's journey from mine to market. Rather, production, refining, transport, financing, and trading are dispersed among multiple countries and institutions. This dispersion means that a disruption in one node, such as the United States imposing a barrier, compels every other node to reassess its position and adjust its strategies. Allies may seek to fill gaps in supply or take advantage of market dislocations, while competitors may use the moment to establish alternative routes and bypass traditional power centers. Canada's swift move to capture a larger share of the gold trade in response to the U.S. tariff is one example of how mid-sized economies can turn global disruptions into opportunities for greater influence. Such actions reveal a critical truth: the balance of economic power is not fixed, and the architecture of global trade allows room for agile players to reshape their role if they act decisively at the right moment. But these same conditions also mean that the instigator of a policy can quickly find itself facing unexpected competition as other countries adapt faster than anticipated. For the United States, the gold tariff may have been envisioned as a way to reassert control over a strategic market, but in a globalized system, every move prompts a counter move. Other nations with significant gold reserves or mining capacity might respond by creating regional pricing systems, establishing alternative clearinghouses, or deepening their ties to markets less exposed to U.S. influence. Such developments dilute the original leverage intended by the tariff and can, over time, reduce the initiating country's role in setting the terms of trade. The unpredictability inherent in these reactions underscores one of the paradoxes of globalization. While it provides a vast arena for economic influence, it also ensures that no single player can dominate without sparking a series of adjustments from others. This dynamic creates a constant state of strategic recalibration, where economic tools that once seemed decisive risk becoming catalysts for shifts in power that extend well beyond the intended scope of the policy.